Hello, everyone, and welcome back to the Coldwell Banker Wealth Builder Expo series. I also want to formally welcome our friends and Wealth Builder partners at Guaranteed Rate Affinity Mortgage. And to everyone, however you got here, wherever you are, we're glad you could join us today. If we haven't had the opportunity to meet yet, hello, I'm Chris McGatt, and I lead Core 4 engagement right here at Coldwell Banker. Today, I come to you from our Coldwell Banker office in sunny, warm, very warm South Florida. And yes, today I'm joined by our good friend, Dr. Elliot Eisenberg. I am confident you're going to really enjoy today's program. As we said before, if you're in search of a proven way to grow and protect your personal wealth, well, you have definitely come to the right place. At Coldwell Banker, we're committed to going far beyond what most real estate companies do. In fact, we believe that by working together, we can support you in building real wealth, something you can enjoy and leverage for years to come, something we call living an exceptional life. And rest assured, we deliver on that promise of helping you live an exceptional life by staying laser focused on our core 4: production power, coaching to confidence, an amazing culture of awesomeness, and, well, why we're all here today, Wealth Builder. Now, just fair warning, if you're thinking that building wealth is maybe a spectator sport, you might be in for a bit of a surprise. Here's what I do know. To get the most out of today's session, you've got to plan to roll up your sleeves, engage in the content, and do the work. Listen, building wealth isn't hard, but it is serious business. And to be successful, it requires focus, commitment, and yes, self-discipline. Now, speaking of discipline, if you haven't done it yet, take the time right now to open a SEP retirement account. Remember, we make it so easy for you to save for your future with automatic closing deductions. Want to find out more about what a SEP account is, or how to open one, or even how to increase the amount you're setting aside? There's a link you can click right now at wealthbuilderexpo.com, or check out the link in the chat section on the right-hand side of your screen. Both will direct you to a site to schedule a confidential conversation with a SEP retirement specialist. Trust me, do it right now before you get sidetracked by life. One of the things I like the most about the Wealth Builder series is we've created this perfect space to explore your personal finances and your goals. This is a place to have open and honest discussions. As you explore building wealth, I encourage you to consider this theory. Stay out of judgment and stay in curiosity. Imagine what could be possible if you had the support and exercised self-discipline. The question really is, how badly do you want to change that trajectory of your financial future? We've discovered that your journey to financial success rarely happens in a vacuum. And that's why we encourage you to invite the support team with you whenever you're attending any Wealth Builder Expo. That might be your spouse, your partner, even for today's session, your team members in the office. Financial success truly is a team effort, so make sure your team is on the field with you. You'll be more successful if you're aligned with the people that matter the most to you. As usual, we'll be recording today's session so you can review it in the future as many times as you'd like. Okay, let's get on with today's topic, entitled Today's Economy and How It Might Affect You and the People That Matter the Most to You. Now, it may seem obvious, but these have been and continue to be tumultuous times. Knowledge is proving to be king when it comes to making smart, informed decisions. Now, don't worry about writing down every tip or strategy that you hear. Again, we're going to be recording the session. In fact, you can check out wealthbuilder.com for recordings of this and many of our prior sessions as well. Great topics like buying your first or next income property, or tax strategies for the independent contractor are all at your fingertips at wealthbuilderexpo.com. Now, as you can probably tell, I am really excited to welcome Dr. Elliot Eisenberg to the Wealth Builder stage today. Dr. Eisenberg is an internationally acclaimed economist and public speaker, specializing in making the arcana and minutiae of economics not only fun, relevant, but also educational. Please help me in welcoming Dr. Elliot Eisenberg. Elliot, it is so good to see you today.
Great to be here. Thank you.
Thanks for being with us, and thanks for sharing all this great information.
My pleasure. I look forward to it.
All right.
It's an absolute pleasure to be here. I have got, as you can probably imagine, given the tumultuous times that Chris has already referred to, a lot to talk about. So let's begin. Let's look at the board here and begin the process. So let's start with GDP. This is all the goods and services produced in the country. Right now, the economy's okay-ish. Q1 had negative growth of 1.3, but Q4 had great growth. If you average them out together, it's about 2.75 over the last 6 months, which is a little too fast because unemployment continues to fall. The labor market is really tight. Inflation's really high. The Fed's got to slow things down, and it's going to do it by raising rates. This is the thing to keep in mind. I'm going to talk about this over and over again. C is household consumption, 69% of GDP. It's starting to falter, and I'll explain why. It's still strong, but it's starting to falter. The second term is I, corporate investment in plant and equipment. It's solid, but it is also beginning to weaken as interest rates rise. The Fed's been raising rates. The third term, government spending, is incredibly contractionary right now. And it is a problem. If you add contractionary fiscal policy, very contractionary, along with contractionary monetary policy, you really got the recipe for a slowing economy. And the question is, how fast does it slow and how slow does it get? We'll get there in a few minutes. Last but not least, exports minus imports, not really important. Mildly negative, but it's always mildly negative, not a big deal. Let's begin by looking at auto sales. You see this interesting process here. COVID hits, and what happens? We stop buying cars. Why? Because we're all going to die. There's no need to buy a car. We're on our way to our funeral. Forget about it. There's no need to have wealth. We're going to be dead. Then we realize, no, this is not true. Let's pay attention. So things get better, and suddenly we're buying lots of cars because we're moving from New York City to perhaps Miami or something, or Missoula, Montana, and you need more cars. And then our supply chains crack. And now we're in this much lower level of production because our supply chains are problematic. That's the issue, right? This is starting to go away, not in the car sector, but in other parts of the economy. And I'll discuss this a couple more seconds, but car production is trying to come back up with some difficulty. And why did our supply chains crack? Our supply chains crack because of this. Look what happens. COVID comes and demand drops by 20% overnight. Here it took, 15, 18 months to weaken completely, and it didn't fall that much. Here it falls almost twice as much within maybe like almost an hour, a week or two, whatever it is. And then fiscal stimulus comes and monetary stimulus comes, demand comes back. Not only does it come back to normal, it skyrockets. So we have this massive decline, then this stupendous increase, and our supply chains go to hell in a handbasket because we've also got COVID going on all over the world. You put this together, we can't keep up with demand because all that money that's coming around through the US and foreign governments. And you can see here, demand for stuff goes up and it doesn't really come down. It's now starting to come down, and this may be a good thing or may not be a good thing. It's hard to tell because this is just goods, not services included, right? So the fact that we're buying a little bit less goods is not necessarily a bad thing. I bought 7 Pelotons. How many do you really need, right? If you look at total spending, however, it looks pretty much on track. As long as this stays on trend, I'm happy. The fear is it will not, because incomes are declining because of inflation, and I'm going to talk about that too. So it's more this number of all household spending on all goods and services that I care about. So far, it's holding up, but we'll see. There are some cracks, which I'm going to talk about shortly. And why did all this craziness happen? Because of COVID. Fortunately, COVID, as you can see here, this is number of deaths, has really declined substantially. And I think it's really moving stage left here in the US and Europe and so on, and most of Latin America and so on as well. People are getting injected more and more all over the world, getting more injected. People have had exposure and so on. So generally, things are better. The big fly in the ointment here is China. They're sticking with their zero COVID policy as a result. And because their vaccination rates are low and the elderly aren't vaccinated and so on, they're going to have a hard time keeping COVID out as these new variants come that are increasingly infectious. So they got a problem, and your supply chains depend on China. This will be an issue going forward as they have these rolling lockdowns and so on. Now, this COVID thing has had a real impact on our psyche, if you will. Look at consumer confidence. So the Fed's raising rates. They've already raised rates 3 or 4 times. They're going to raise rates 3 or 4 more times. This is going to be an ongoing process. But look what they're doing. They're raising rates into an environment that's quite weak. Consumer confidence measured by the University of Michigan, you can see it's now at 50. When COVID hit and things were most bleak, it was at 70. We are much less happy today than we were 2 years ago. Why? COVID's around, inflation's bad, and everybody suffers from inflation. If unemployment rates rise, only the unemployed suffer. It's a few percentage of the population. But inflation we all see, and on top of that, wages aren't keeping up with incomes. So people are slowly becoming slightly poorer. This doesn't make us happy. And this is not in isolation. If you look here at manufacturing sentiment, it's 50s neutral, so it's not bad. But it's certainly declining because they can't get workers, input costs are more expensive, they can't get trucking services, they can't get parts, they can't get raw materials. And it's not confined just to manufacturers. Look at service providers. So think hotels, airplanes, spas, whatever it is, right? Racetracks. I'm just making stuff up. But you can see sentiment there is now average. So you've got consumer sentiment, which is weak, manufacturer and service sentiment, which is weakening. And then look at small business. Pretty lousy. So you've got an economy that's clearly, sentimentally at least, slowing down. And in part, it's because of inflation and reduced incomes, which we'll get to in a couple of seconds. So the Fed ideally would not like to raise rates in this environment, but they've got no choice because inflation is really out of hand, if you will. It's the highest it's been in 30, 40, 50 years, depending on how you measure. And why? In part, it's because there's nothing to purchase on the store shelves. This is inventory to sales ratio for goods. And historically, you see the orange or yellow line is between 1.4 and 1.5, a little bit lower, a little bit higher, but generally there. Here, it was way lower for a long time. If things aren't on the store shelves, the price of what's on the shelves goes up. Cars, used cars, campers, laptops, and so on had this huge run up in price, driving inflation. Now, many of these problems will go away. The computer chips won't, and that will keep cars being underproduced and other things that depend on chips. And the problem with the chips is now the firm that builds the machines to make the chips can't get enough chips. So you're now really behind the eight ball on this. So this will slowly go away. It's already gone away for many things like apparel, but for technological things, it's still a ways to go. In terms of supply chains, they're getting meaningfully better. They're still awful, but they're better. If you compare it to 6, 7, 8 months ago, it's about the same as it was in November, December, January, February, March. April was worse, but the last couple of months, it's slowly improved. So the worst is over. Why? Firms have learned to live with COVID. Demand for stuff is declining, and global supply chains are starting to improve. The cost of shipping things is coming down. There are more ships available. Things certainly haven't returned to the way they were, but they're starting to get better. And if you look at all the indices here in the U.S. put out by the 5 Fed banks, all of them show, the 5 that have surveys, all of them show improvement in supply chain issues, duration, how long it takes, how many weeks will it take to fill orders or get orders filled, whatever it is. Things are improving. The fly in the ointment here is energy prices. Oil prices are way up, and they're not likely to come down in the near future. The shooting war in Russia and so on. But over the next year or two, I expect the U.S., I expect Canada, Brazil, and China all to increase oil production. OPEC will do some as well. The war in Europe, the shooting war with the Russians invading Ukraine, hopefully ends sometime soon. But oil prices aren't going to be coming down terrifically a lot. The other thing is natural gas prices are very high, and they're also not likely to come down in the long run. In the long run here, the oil in the short run, natural gas in the long run, because we're exporting now much more natural gas to the Europeans as they try and wean themselves off Russian natural gas. Now, the reason I mentioned earlier that goods inflation is not going to be so bad and supply chains are improving is in large measure because of this. Capacity utilization in firms is doing well. If you look here before, this is COVID, the recession, the 2-month recession in this gray line. A year or two before we were here, that was the highest we had been in years and years and years since the housing bust. Now we're approaching that. So firms have figured out how to live with COVID. Their workers come, their workers go. Some have COVID, some don't. They wear masks, they social distance, they make things off-site, whatever it is. Demand for stuff is declining, capacity to produce is improving. I think goods inflation goes away. It's more service inflation and wage inflation that I'm particularly concerned about. But goods inflation should, again, like COVID, move stage left. And that's good news, right? Now, let's talk about wealth. Household wealth took a bit of a hit in Q1. This is through Q1. You can see it decline slightly because the stock market did poorly. House prices continued to rise by 15, 20% nationally, but the stock market went down, and the stock market pulled wealth down with it. Now, this may go on for another quarter or two. We'll see. We'll talk about that a little bit. It will eventually end. Home prices are continuing to rise, and that's putting a buffer, a base below this. So this is generally speaking good. If you look at the beginning of COVID here in February of 2020, you can see this massive divot. That's the stock market declining at that point. House prices hadn't begun their run up yet. So this was a pure stock market effect. Here, you've got a stock market effect pushing down, but house prices pushing up, mitigating the effect pretty strongly, right? Here, all you had was a stock market decline, but then came fiscal and monetary policy to the rescue. The stock market improves, rates collapse, bonds go up, and so on and so forth. This looks good, but there are cracks being exposed here. And that's why I think consumer spending is now beginning to peak out and may begin to grow very slowly or may contract slightly. Here's why. Look, real incomes are declining. Because, yeah, sure, incomes are going up 5, 6, 7%, some of the most rapid increases in decades. But the problem is inflation 7, 8, or 9%. So inflation's a little more than income. So over time, incomes decline. We've had now 7 or 8 months in a row of declining incomes. This is beginning to matter. For a household of 2, 3 people, this is $4,000 or $5,000. This is not an insignificant amount of money. So spending, people are nervous. So look, you can see here, one of the manifestations of that is this. Savings rates have plummeted. As people say, wow, inflation's eating away my income. I have to pay for rent, food, fuel, gas, whatever it is. I'm going to have to do it out of reduced savings. So savings rates now are as low as they were at the peak of the housing boom. Before that, they had never been this low. So this is a sign of something not quite right. And moreover, credit card use is also ramping back up very rapidly as households go back to older patterns, but exacerbated by this declining real incomes. This will stop at some point. More jobs, inflation comes down. But in the short run, this is certainly going to put a damper on GDP growth here in Q2. I don't think we can get better than 1.5%. We had negative in the first quarter, 1.5% in this quarter. This is not shaping up to be a particularly good first 6 months of 2022. Now, add to this, contractionary fiscal policy. And this is, I wouldn't say worrying, but it's worrying when put in concert with tightening monetary policy. Let me explain. This is the dot-com bust, and we get some stimulus checks, and then we have a recovery. We have contractionary fiscal policy. Here's the housing bust, and President Obama has the shovel-ready projects, ARRA, and so on, and then we have some contractionary policy to bring the deficit back under control a little bit. Here's the lockdown of COVID. Massive fiscal stimulus, much bigger than here or here. Each one gets progressively larger. But here it's 4, 4.5%, 5%, and even almost 6% for one quarter. And now look at the massive contractionary policy that follows. This is intense. When you go from up 4 to down 3, that's a change in GDP of 7 percentage points merely because of government policy. Now, other things are doing well. We have more income because of that and so on. So there's counterbalancing forces to some extent. But this in and of itself is not good news. And now we're going to have contractionary fiscal or starting to have rising rates. It's not tight, it's just beginning to get tighter. So I think we're due for a recession. There's no doubt. Fiscal policies tightening, monetary policies tightening, incomes are declining, the globe is going to slow down, China's slowing, energy prices are up. There are a lot of headwinds facing the economy. So if you look at this, all these vertical bars are recessions. In every case, it's preceded by the blue line going up. That's a rise in interest rates, tightening of monetary policy. Now note, there were 3 times here, here, and here where rates went up. And there wasn't followed by a recession. So of the 10 recessions we've had, there have been 13 times rates have hiked, I think it is. So 10, 13 isn't a great ratio. If I said to Chris, hey, there's a 10 and 13 chance you'll die from this surgery, I bet Chris would say, let me hold off. But the economy doesn't have that choice. Inflation's very bad. So you might say, well, look, why can't we do this, this, or this? Easier said than done. The problem is the last time this happened here and the other times as well, the Fed raised rates proactively to prevent inflation from taking off. But once the inflation gets out of the bag, if you will, bringing it down ends up creating recessions every time. So every time inflation's above 5% and the Fed raises rates, you wind up in a recession. Every time inflation's above 4% and unemployment is below 4%, like it is now, you end up in a recession. So I bet we end up in a recession. So the next question becomes, when does it hit? And traditionally, you can see here it hits about 2 years after the first rate hike. I think this time it happens quicker because the rate hikes are coming fast and furious. The first rate hike was 1/4 point. The second rate hike was 0.5 point. The third rate hike was 3/4 of a point. And the Fed may well raise rates by 3/4 of a point, a couple meetings, certainly half a point for several meetings. So the rate hikes are front end loaded and not even across time as they have been traditionally. This front end loading of them makes the impact of them felt earlier. I suspect we get the recession. I'm going to be wrong about this because no one knows the future, but somewhere early 23 seems reasonable, very late 22. So think about this as you position your portfolio and so on. Now, the next question is, how long will it last? I don't think it lasts particularly long. For some guidance, this is the Great Depression. So don't think too much about the earlier stuff. That's so long ago. Even some of this stuff is old. But the point is, notice that generally speaking, over time, the duration of recessions declines because we're smarter. We understand the uses of monetary and fiscal policy. So I think this is a norm, and this is not a recession where we have to reprice assets. That took place in 74 with the oil embargo, and again in 2008 with the house price collapse, housing bust. But generally speaking, we don't have a lot to do here in terms of repricing of things. Therefore, this is more of a garden variety economy growing too fast for the productive capacity able to grow. Right? You can't get workers, parts, labor, imports, supply chains. Demand is strong. Slow it down. We'll get the recession. It ends in 8, 9, 10 months, sort of a normal garden variety thing. Now, this is how bad this, how long do these bear markets that we're in now last, right? Bear market began Jan 1st. So now we've been in this bear market 6, 7 months, right? How long does it last? Well, not that long. The median's 8 months, the average is 11. Right now we're in 5, 6. So, if this is an average type of bear market, it goes 4, 5, 6 more months. By the end of the year, it's probably over. There's no guarantees in life, and a lot depends on how fast the Fed raises rates. And a lot of that depends on how bad inflation is. That's the real issue. And then how big are the declines in bear markets is a big question. And you can see they vary. So we're now down 20, 25% ballpark now. And you can see historically since end of World War II, what you end up getting. Median's 25, 24, so we're roughly there. I think there's a little more to go as the Fed keeps raising rates and surprises us a little more. But 4 or 5 more months in the duration, if it's normal, if this is normal, we're already there. I don't think we're there yet. I think it can go a little further. Markets are nervous, inflation's uncertain. As these inflation numbers come out, if they continue to be bad, this will push the stock market down. We're getting there. I mean, this is, if you're over 35, you've been through a couple recessions. If you're over 55, you've been through a number of recessions. We'll get through this. Now, let's talk about labor markets. They're really tight. And that's the problem. It's generating inflation. Look how fast we've recovered. Here we lost the dot-com boom. We lost 3 million jobs, peak to trough. Took 4 years to get the jobs back. This is the housing bust. You may know something about that given your profession. We lost 8 million jobs. Took us about 6 years to get the jobs back. This is the lockdown, great lockdown, COVID. We lose 22.5 million jobs. By the end of July, which is now just a few weeks away, we'll have all the jobs back. That's remarkably fast. No one banked on this, especially the Fed. As a result of this rapid improvement, the unemployment rate has literally plummeted like an anvil being pushed off a cliff in a Bugs Bunny cartoon. This is unprecedented. Look how many years it took for unemployment to come down from the dot-com boom. Took a long time. Or here, the housing boom. Took a long time. Here, it's crazy fast. Now, part of the reason this has happened is a few people have dropped out of the labor force. Not a lot. At this point, about 1.5 million workers, 1.5 million. Not that many. But you can see it here. The labor force participation rate fell. It bounced back pretty quick as we got out of the lockdown in June, July, August of 2020. But then it stayed there. Why did it stay there? It stayed there because people were being paid not to work. They didn't have to they didn't have to make their rent payment or their mortgage payment or their student loan payment. They got a PPP loan they didn't have to repay. They got unemployment insurance that exceeded their incomes in many cases. And then in 21, they got child tax credits. So people, for example, like Henry, just decided to stay home and not work. Or someone like Mary decided to stay home and not work. Then at some point, and the stock market was booming and my mem stocks were doing well. Bitcoin was rocking, didn't have to work. But then it all starts to reverse. You got to pay your mortgage, pay your rent. Bitcoin does poorly. Mem stocks decline. The stock market does poorly. Interest rates rise, driving bond prices down. And you got to go back to work. And that's what we're seeing. That said, demand is super strong because fiscal policy was so wildly expansionary for so long. People saved money. Chris had big plans to go on that big trip with his whole family. They were going to fly to Europe or Asia or something in 2020. Didn't happen. But Chris saved up the money. He says, oh, let's buy an airplane. Let's buy a camper. Let's buy another house, down payment or whatever it is. So this is what people did, and this drove the economy, pushed demand, broke supply chains, created inflation. Now, more workers are going to come back. Let me explain. A lot of workers retired. This was the trend pre-COVID, and you can see it jumps up in COVID. People suddenly are rich. Their stock prices are up. Their bond prices are up. Their home is worth more money. They retire. Some people want to retire, and then they realize, oops, inflation's coming, or is here and is wrecking my nest egg because I didn't plan for my wealth and savings properly, like we talk about in this course, and therefore they got to go back to work. That's a sad story for them. Good for the economy, bad for them. Another reason is daycare. There aren't enough daycares open. Schools aren't fully open. It's improving rapidly, but some people still have to stay at home taking care of the kids, right? Another reason is death. If you look at the last 27 months since COVID was in mid-March. Now we're roughly 27, 28 months later. Compare that 27 or 28 months pre-COVID, number of deaths, extra 1.2 million. Some of it's COVID, some of it's cancers that weren't detected, some of it's heart attacks that they couldn't get to the hospital because of COVID, whatever. But those workers, about a quarter of them are workers, they're not coming back. That costs the economy. Then there's just being sick. This is the worst of Omicron. The worst of Omicron, almost 4 million people weren't working. What were they doing? They were on their cell phones, buying things on Amazon, worsening supply chains, creating more inflation. But that's now gone, right? People now are back to normal. Half of us got Omicron. We've had injections. We've had extra injections. We've had boosters. We've had double boosters. Yeah, slowly the herd immunity comes to the country. That's why new variants that become less and less meaningful going forward. Then there's immigration. If we had the same policies in effect when Obama was president, we'd have 2.5 million more immigrants, legal immigrants, many of whom would be working. And we also don't have a lot of population growth because of births over deaths, because people aren't having a lot of kids. They're watching, Netflix or football or whatever it is, right? And on top of that, people have opened their own businesses. Look, think about it. In 20 and 21, you didn't have to pay your rent, didn't have to pay your mortgage, didn't have to pay your student loan, 22 for that matter, right? No student loan. You also got some stimmy checks, child tax credits, unemployment insurance for various parts of those years that exceeded the income that you earned if you were a lower income earner. Those workers said, I'm quitting. I'm going to pursue my dream and become a manager, become an owner. Or someone says, look, I used to clean floors, but now I want to be a pilot for Delta. And they apply and say, I used to manage things. I can manage an airplane. No problem. There are buttons. I can do it. So people can get the job of their dreams because the labor market's so damn tight. So these people are no longer they're no longer employees. And if you're an employer, you aren't counted in the data, right? So what do? You get workers quitting in droves, driving up wages. Look, this is the dot-com boom. 2.4% of the population, the blue line on this side of the axis, quit their jobs every month. Peak of the dot-com boom. Peak of the housing boom was 2.2. Okay, good. Here's pre-COVID. Unemployment's the lowest it's been in 50 years. Let's go back here a couple slides, and I'll show you, I'll break that out for you. Here, this unemployment rate right there, lowest in literally 50 years since the Vietnam War. So when unemployment's that low, people quit their jobs too. And you end up with this, 2.3, 2.4. So 2.4, 2.2, 2.3, 2.4. What's the number now? Now it's 3. This is 20% higher because everybody knows there's a labor shortage and every company out there is putting up signs. McDonald's is offering now $48 an hour. Okay, maybe I'm joking, but you get my point. If these jobs are so plentiful, someone's unhappy with their job, they're going to go get a new job. And what does that do? Drives up wages. So look here. If you quit your job, you get close to 8% pay raise. If you stay in your job, it's closer to 5. That's a big gap. It pays to quit. You listen to Johnny, what's the singer that take your job and shove it, You go like this to your employer because you can go, Johnny Paycheck. You can go, right? Because there's so many jobs. This is causing inflation. So is there inflation? you better believe there's inflation. And that's why the Fed's got to clamp down by raising rates. You've got all this workers are quitting and they're getting paid more. It's seeping into the economy. The Fed has to clamp down and has to start clamping down hard. And they are. They're behind the curve, but they're clamping down. Let's look at the details. Now, sometimes they try and sneak the inflation by us, but we're not that stupid. We catch on. Let's look at the details. This is the CPI, what you think of as inflation. And what do you see? This rapid increase in inflation. The blue is headline, including food and energy. The red excludes food and energy. The good news is the red's going down, and the blue is no longer going up much, right? It's kind of leveled off the last month or two. That's good news, but it's incredibly high. Look at the graph. We haven't had this. This is 1990. You've got to go back to 1980 to get this, 83, 84 to get inflation rates this high. The Fed has to clamp down regardless of the impacts on the economy, because the longer the Fed dallies in raising rates to slow down the inflation, the worse it gets, the more embedded it becomes, the more wages go up because of prior inflation and so on and so forth. So they have to do it regardless of the cost. And that's what you're hearing the Fed say as they pivot to saying, we need to get rid of inflation. Now, you can see why in this graph. If you break down where inflation's coming from on a month-over-month basis, look, it's mostly coming now in the yellow. The yellow is services. And our economy now is pivoting back from a lot of goods, Pelotons, pavers, Weber grills outside, pergolas, whatever. It's now moving towards services. We're traveling, we're going on vacation, we're taking trips, we're going to rock concerts, whatever it is, right? And you can see service inflation, it went up and came down there, but it's been generally steadily rising. If this doesn't come down, it doesn't matter what it happens anywhere else on supply chains with goods or with food or with energy. Food and energy are going to bounce around like they historically have. But even if they all go away, this service stuff being driven mostly by wages is a problem. And that's the biggest fear the Fed has, that this doesn't go away. So what's the Fed going to do? They're going to raise rates a lot. That's the story. Right now, rates are here at 1.58. The next Fed meeting, they're going to raise them by another 0.75 of a point probably. By the end of the year, another percentage point as well. 2 or 3 more hikes of 50 basis points or 25 basis points, but some combination. And then it keeps going up a little bit. And remember, GDP growth is slowing. We probably enter a recession. And even if we didn't have a recession and the Fed didn't do much, regularly GDP growth would slow to roughly 2% by the end of next year, 1.8, 1.9, 2.1, because that's the normal rate of growth. If inflation comes down and GDP growth weakens, and we still have interest rates at the Fed funds level this high, this is a pretty bad recipe here. So I really think we get a recession. Again, not that long, not that bad, but we get one, right? And here's the last reason I'm concerned. There's rent inflation. Because there's nowhere to move. You can't find a place to live, be it buying a place or renting a place. We'll talk about this more in a couple of seconds. But this is 30% of the CPI. If this alone, so if everything else goes away, goods inflation, services inflation, energy inflation, food inflation, wage inflation goes away, and all we have is this is alone enough to raise the CPI by 1 or 1.5 percentage points, which could cause a lot of indigestion for the central bank. So let's talk about housing, and then we'll hopefully have time for some questions and answers. Housing is an inventory story, and I want you to focus on inventory very closely going forward because it's starting to rise. First, the history. It peaked out at over 4 million units for 1 month back in middle of 2007 when things were really dire. And then it essentially, there were a few exceptions, it steadily declined for 13 years. It bottomed out earlier this year in February or March, 800,000. That was a decline of 80%. Peak, I understand, 1 month, I get the point, the trough. But even now, when it's up at 1 million, it's down by 75%. This is a massive decline. In any sector of the economy, when supply falls by 75%, inventory declines, you're going to have some price increases, no question about it. And this is why. Look at the relationship between inventory, 2 months, 4 months, 6 months, 8 months, 10 months, and price appreciation. This is 6% a year, 12% a year, 18% a year, 24%. These are monthly information here. And when inventory is at 2 months, like it is now, price appreciation is, 1.5 in a month, 18 to 24% a year. And if you look at the data from FHFA, the regulator of Fannie and Freddie, Redfin, Case-Shiller, NAR, they all show somewhere between 15 and 22% a year. They all look at the market a little differently. Some are more current than others. Some have other advantages, but they're all showing very high rates of appreciation. This is going to stop. It's going to slow down. Why? Because well, first, look at home prices as a result. They've been high and rapidly growing at almost 20, 21, 22, 15, 22%. This is a long period of time of very rapid price appreciation because inventories have been very low. But now, look at that. Inventories were, last time inventories rose year over year was here. Let's go back a couple of slides. Go back here. First 6 months of the year, inventory rises, and then it goes down. First 6 months of the year, it goes up and down, up and down, up and down. It's a sawtooth pattern. That's what it does. So if I know that inventory's up in April compared to March, or down in August compared to June, meaningless. But if I look at it year over year and it goes up, that's a whole different story. And that's what we see in this graph right here. The last time inventory rose year over year was late 18, early 19. And the reason was the Fed jacked rates up too much in 18, 4 times by a quarter point. In 19, they walked those 4 increases down back with 4 cuts or 3 cuts. And then the housing market just took off like a bat out of hell. And inventory started declining year over year. Now it's declining faster and faster and faster and faster and faster. It peaks out in early 21 at year over year declines of 55%. At this point, there's not much inventory left, right? It's still declining now year over year, but less quickly. 40%, 30%, 30, 20, 10, 0, and now it's growing by 15. This is Realtor.com data. NAR data will come out and show this month or next month, but very soon we're going to see year over year same, and then year over year going up. Because this is going to match up. This data comes out more frequently, but it's largely the same data. This is telling us there's something going on. This is meaningful, right? We can argue what the impact will be, but it's going to be more inventory, lower price appreciation, and some few places maybe prices decline by a little. But this is not going to be 2006, 2007. Don't worry. So let's look at the actual data. Shows housing sales are declining. They went up like crazy because of COVID when we all wanted to escape our houses and get backyards and get a swimming pool and a veranda and all that nice stuff. Then it kind of roars back up with Delta and Omicron. And now it's starting to weaken because there's no houses to buy, even though inventory's up. It's still very, like in Denver, for example, maybe inventory goes from 7 hours of inventory to 10 hours of inventory. A huge percentage rise, but there's still nothing to purchase. So it could take a while for inventory to rise before we see an impact on prices, but the impact on prices will occur. Now, how far low does this get? I think we end up somewhere around 5 million units sold over the course of a calendar year. Now, if we compare that to the housing bust, we were at 3.5, 3 1/3 for a month and 4 million for quite some time. This will not be the same. Households still have lots of money. There's lots of wealth. Banks are in good financial positions. Other parts of the economy are not going to collapse. This is a regular recession. Households also have lots of home equity. So even if house prices decline, God forbid, a little bit, that's okay. There are investors that are buying lots of residential property for rental purposes. So it's a very different world out there. And credit conditions are much stronger because of Dodd-Frank and other associated tightening up of credit conditions. So the FICO score of buyers is very high, and the unemployment job losses aren't going to be nearly as big as they were last recession. So there could be some issues here. But think back to 1990 if you're old enough to remember. If you weren't born yet, it may be hard. Look at some textbooks. Now, why is there the problem? Look at how much you got to spend of your income to buy a house. The fact that house prices went up by 20% in the last 12 months, and now interest rates have risen by almost 100% from roughly 3 to almost 6. That's putting burden on households. Some are having to pull back. The problem is, where do they go? They rent. Back in 2007-8, rental prices were collapsing. So you could default in your home, rent an apartment, and save a lot of money. But now rents are going up. So that's discouraging people from leaving their homes as well. Again, giving added protection to the housing market. The housing market is, again, in a very different place than it was 12, 13 years ago. Don't reflexively go back to that period of time. It will not do you any good, right? Now, this is super current information on first-time mortgage applications. People are looking to buy a house. They haven't bought one in at least 3 years, by the definition. And you see there's deterioration because the blue is this year, and you compare it to all the prior colors. Early in the year, the blue is the highest dot. Still the highest dot. Now 1 year is better. 1 year. Now it's 2. Now it's 3. Now it's 4. but that went down because of the holidays and weekends and stuff. It's back up. There's deterioration compared to other years, but it's not falling off a cliff. This is okay. This is a controlled, slow, steady weakening because rates and prices are higher. And now prices are going to start to slow down their appreciation because inventory is going to start to rise. And that will ameliorate the problem. And that's what happens every time. On top of that, look at new home inventories. They're starting to rise. As a result of that, look at builder sentiment. It's really come down. It was at a fantastically, comically high level at 90. Now it's down to the upper 60s. That's a meaningful decline of almost 25 points. If you look historically, when builder sentiment declines by large amounts, a recession, a recession, a recession, a recession. Not here, but 4 out of the 5 times in the history of this index, when builder sentiment falls by more than 20, 25 points, you wind up with a recession. I suspect we end up in a recession now as well. The higher rates are what's doing it. They don't build many homes. They let go of their workers. Unemployment's rate rise, and we're off to the races. Construction, commercial construction, industrial construction, exactly the same thing. You can see here, single-family construction is not going anywhere. Builders aren't building more. We're still vastly underbuilt. So as soon as the recession ends, household job creation begins to improve, rates come down, household formation gets better. We all want to buy a house or rent an apartment, and there's nowhere to do it. That's why the housing market hit. There'll be a hit, but it's nothing like it was in 07, 08. Moreover, builders aren't building because the cost of inputs is crazy high. So they can't get land, they can't get workers, the cost of capital is going up, and now buying inputs is more expensive. So the builders will never catch up with the shortage of houses that were generated here. We were massively underbuilt during this period of time. There's no way we can get back to there. And over the next 5, 10 years, this problem gets worse because this is peak person, 32 years old. Peak home buying year is 33 or 34. This group of people, this younger millennials, are aging into peak home buying without any homes. Now, am I right? Have I convinced myself artificially that the housing market is going to have better strength and stronger legs this time? Look at apartment vacancies. There aren't any apartment vacancies. This is the lowest it's been since the early 80s. You can't buy a place. You rent, it goes up. That's going to discourage you from giving up on your house because you'll say, well, I'm going to have to rent, and rents are going to go way up, and I better prefer to own than rent. So the rental market's not going to be encouraging to getting rid of your house. On the contrary, it's going to encourage you to keep your house. So again, the housing market's different. And then last but not least, I figured, what can you do? There's no place to buy. There's no place to rent. You can't get a new or an existing house. So I think Chris McGatt's going to live in a double wide. That's where I want to see Chris, because he's a fancy guy. He needs to live in a nicer, not a single wide, but a double wide. The problem is, look at the cost of a double wide. It's gone from what, $108,000 before COVID to now $152,000. You don't own the land, and you don't have a pad to put it on. You don't have services, electricity, water, and sewer. Water, sewer, or septic and well, this is going to be very expensive. This adds a lot of money to this. That's why, if this is the base, this explains why home prices are so expensive. So wrapping it all up, 22 will be an okay year. I think the recession comes in 23, maybe December or something late this year, when the interest rate hikes that are happening now begin to really make themselves felt beyond the housing market. The Fed will keep raising rates every 6 weeks for the foreseeable future. And that's what's going to drive us in. As consumer sentiment is weak and fiscal policy is contractionary, the globe is weakening, Europe's going to go into recession, China's not growing fast, very slowly. So there's a lot of other problems, but this is problem number one. We should still create a bunch of jobs, and by the end of July, this month, we should have recovered all the jobs we lost in the recession. Inflation is now peaking, whether it's this month or next month or the month after. We're now getting there. The key thing is we want to get there quickly, and we want to see inflation rates drop very rapidly. If they fall very slowly and casually, the Fed keeps raising rates, maybe by smaller amounts, a quarter point, 25 bips, but they keep raising. And the more they raise, the higher the likelihood of a recession. And the path that they're on now very strongly suggests we're going to wind up in recession. We're going to spend more on goods, services, and less on goods as we pivot our spending. Remember that inflation graph I showed you, that the yellow part's going up? That's part of the problem. Last but not least, I want you to focus as realtors. I want you to focus on inventory. because as that rises, price appreciation comes down, bidding wars go away, buyers have much more control over the process, there's much more to look at, they're not going to be nearly as trigger happy as they've been in the past. And now as wealth builders, I want you to focus on inflation and unemployment. As inflation goes down, the Fed will raise rates less. But how fast will it fall? If it stays high and starts dropping next year, it's way too late. That's going to do us no good. We need to see it peak now and drop quickly. Otherwise, the Fed will be forced to raise because they're behind the eight ball, and their credibility depends on them now being in the forefront of the fight and raising rates very rapidly, which will probably drive us in recession. Also follow unemployment. It's going to start to rise, presumably. If it falls by chance, whoa, the Fed's got to raise rates faster because that's going to cause wage inflation more, which will cause more overall inflation. Wow, there's a lot to swallow here. This is being taped. Again, you have a chance to look at it going forward. This is my name, cell number, phone number, Twitter handle, email address. I put out 70 words every day on the economy. No graphs, no ads, no charts, no links, no photos. To get it the easiest way, take your phone, text the word bow tie, one word, to the 5-digit number 22828. 22828. Be prompted for an email address. You'll hear from me every day. It's been a pleasure. I hope I've given you food for thought.
Elliot, thank you so much.
My pleasure.
You don't disappoint. You got to
thank you
for a quick second. Yeah,
I like to. Thank you.
You know, you have a lot of fans at Coldwell Banker, and when word got out that you were going to be presenting, give us an update on the economy. Well, I got a bunch of calls, I got a bunch of emails, and some questions. So if you don't mind, I'm going to pitch a couple over to you.
By all means.
Excellent. This one came up 2 or 3 times, and quite frankly, I hate to be naive, but I didn't know about it. This idea of a Series I savings bond.
Yeah.
Tell me more about that. What is that?
So most bonds are treasury bonds. You know, big banks buy them in tens of millions of dollars at a time. But this I series bond is interesting. It's available not for big banks. It's only available to individuals. And you can't buy more than $10,000 a year. Now, if you have a trust, you can buy a little more, a husband, a wife, kids, and so on. But it's essentially $10,000 per person. And there are some limits on it. So if you sell it within the first year, if I'm not mistaken, I'm not an expert here, you lose the first year of interest. But once you have it for at least a year, if you sell it within the first 5, you lose one quarter's worth, or 3 months worth. So, and if you spend it on like school education, I think it's all tax-free. And you can recognize the taxes in some favorable ways. But the limit is $10,000 a year on almost all circumstances. If you have a tax refund, you can apply $5,000 of it, up to $5,000 towards bonds. You get $15,000 that way. So you get a deliberate refund, build up your overpayment. Okay. But the interest rate on these bonds is set once every 6 months. Last 6 months, it paid, I think something like 7.5. Right now, it's paying 9 1/8 or 9.1 or some ridiculously high number. It's tied to the inflation rate, but you're getting terrific returns. Small amount of money, but a great return. Do it. It's easy.
Great to know. Thank you. And I'm so glad this was recorded because I'm going to have to watch this myself 3 or 4 times.
Me too.
To get all the information is fantastic. Listen, you know, so many of the people that are watching right now are thinking about the real estate market and how it's transitioning right now, and wondering what will units, and you touched on it a little bit here in your presentation, but units, just the actual number of homes sold year over year, how quickly are you seeing that change, and what direction are you seeing it change?
Unfortunately, it's going down. There's no question. I think you look at across the country, you look at number of bids per house is declining. Right. The percentage of homes that are now having a price cut, it isn't huge, but it's going down, it's going up, not going down. Right. So all the indicators are weakening. I suspect with these high rates, we're necessarily going to see less demand. There's no question.
Makes sense.
Now, how low? I mean, again, as I pointed out, for a few months in the housing bust, we had 3.5 million units for sale for a few months, or even 4 million for the better part of a year. I don't think it gets below 5. I really don't, because there's strong demand and there's nowhere else to go.
Right.
If you keep your job, right, and when most people are, and unemployment will rise a bit from maybe 3.5 to say 5. Right. Yeah. This is not great if you lose your job, but objecting in the grand scheme, not a lot of job loss. This is not going to be like it was. Moreover, remember, people who refied now have mortgages under 3 or 3.25. So they're not going to want to sell their house. So the supply of houses entering the market, even if the things aren't great, is not going to be a flood, because people are going to say, this is the rate of a lifetime. I'm never going to give up this house.
Exactly.
I'm going to die in this house and go out feet first. So there are so many reasons why this will not even come close. But I think 5 million probably is the bottom.
Okay. So a lot of people are either in the rental market, meaning they're an investor and they own 2 or 3 income properties, single family homes or condominiums,
Right.
and they're wondering, do I go in and double down on that? Do I buy 1 or 2 more investment properties right now? Do I wait a little bit? Rents obviously are tracking right along to sort of offset those new high prices. What are your thoughts on that investor sort of on the fence right now?
I'm pretty bullish on the housing market as a whole. And it was those last couple slides that really gave me confidence. Apartment vacancy rates are ridiculously low, and the cost of building a home with a trailer ridiculously high. So look, over the next year or two, it could be some bumps could happen. We don't know how long the bumps will last, how big the bumps will be, when the bumps will end. But as a stock buy, as a buyer of equities, I also own some real estate as well. It's like, you don't know when the bottom will hit. So you just stick with your plan, do what you know, and
Right.
go. I would certainly not say, whoa, this is a bad time to invest in property. Yeah, it could fall by 5% or something, but this is what you know, this is what you're good at. And we know it will, on the other end, it will come out well, whether that's the end of 23 or middle of 24, yeah, whatever. But you're going to hold the property for a good long time. So you don't have to catch at the bottom. Look, when you buy every 2 weeks, you buy stock for your 401k or 403b. Do you know what you paid last time you bought IBM or Google? We should think of housing in a similar fashion.
Great perspective.
It's a good investment. Don't worry about the price you buy and sell. It's a long-term asset. You're going to get income, rents, whatever, capital appreciation. A couple more points, a little bit here or there, not important.
Excellent insight. We have time for 2 more questions.
Okay.
And I think this is bubbling up all over. There seem to be 2 different types of consumers, right? There are consumers that are thinking in their minds right now, oh my gosh, how do I batten down my hatches? How do I not lose wealth? And then we have another group of people that say, I want to be able to, I'm willing to risk a little bit. I want to get out there and see if I can make some money in the next 2-3 years. What are the 2 quick strategies for those very different desires?
I think they're the same.
Okay.
They really are. And I'm not a financial advisor, so you can't sue me.
We'll understand that.
Talk to your financial advisor and your lawyer and your accountant and all that sort of stuff. But the U.S. isn't going anywhere. We're a big country. We're pretty well run. There are problems in politics, yeah, but we're dynamic. We're aggressive individuals. We like to form businesses and take risks. We don't know when the bottom of the stock market is. Look, the Fed doesn't know how high to raise rates, how quickly to raise rates, when to start lowering rates, because no one knows the future. But we know that we always get out of recession. So I'm really a strong believer in sticking with your plan. Today, I'm 1 day older than I was yesterday. There's no need to drastically change my plan. Yes, will my stock holdings or potentially my bond holdings or whatever they are, my house holdings conceivably weaken or do some cases go down in bonds and stock, house prices, appreciation slower. But it'll turn around every prior recession. Think back to the bad housing bust. If you bought a house in 2007, just before the recession, in most cases, you're above water now. In a few cases, you're not, but almost everywhere else you are. If you bought a house every year over the last 13 years, you made a killing on the last 8 or 9 houses, and you still may be a little bit weaker on the first 2 or 3. And the stock market's done terrifically well from the housing bust and the dot-com lockdown. The COVID lockdown.
Yeah.
So I'm a firm believer in sticking with whatever you're doing. And maybe even if you have the internal fortitude, take a little more risk and enter now because things are better. It's easier as an investor. Stocks on sale. Yeah. The house prices are going to be going up less now than they will be in the future. This is a better time. But you have to have the stomach to stomach the risk.
To get through. Well, that
if you can't, just don't sell.
Right?
Don't sell.
Don't sell.
Don't sell.
Oh, listen, this sage advice we so appreciate. We love your enthusiasm. We love your perspective on the economy.
Thank you.
Thank you for your time today.
My pleasure. It's been great.
Well, that's a wrap for today's session, entitled Today's Economy and What It Means to You. I'd like to thank the entire Wealth Builder team that made today's session possible. And of course, a big thank you to Dr. Elliot Eisenberg. Just a reminder, a recording of this program and many of our other sessions can be found at wealthbuilderexpo.com. We look forward to seeing you at our next Wealth Builder Expo on October the 20th with Gene Chatsky. Yes, the Gene Chatsky, the financial editor for NBC. But until then, I'm Chris McGatt, encouraging you to stay focused, disciplined, and committed to ensure that your best financial years are just around the corner. Thank you for joining us.